Warren Buffett's investment advice has stood the test of time. Investors can avoid some of the usual pitfalls that harm returns and imperil financial goals by following Buffett's investment recommendations. Welcome back to the channel. In today's video, we show you how Warren Buffett decides it's time to sell a stock. Before we get into the video, don't forget to drop a like and subscribe to the channel if you haven't already. Make sure that the post notifications are turned on so that you'll never miss a video from us. Without further ado, let's dive in. As Warren Buffett frequently mentions, his preferred holding duration is indefinite, but this does not always work out. The Oracle of Omaha and his team, in actuality, sell stocks on a frequent basis for a number of reasons. In fact, only 3 of Berkshire Hathaway's 9 big stock positions from 25 years ago remain today. There are, however, good and bad reasons to sell stocks, and Warren Buffett's previous comments as well as Berkshire Hathaway's actions might point you on the proper path. Warren Buffett's method for determining when it's time to sell. Buffett reacted to a query on when he'll sell a stake during Berkshire Hathaway's 2002 shareholder meeting. Berkshire Hathaway had lately sold McDonald's and Disney stock after holding them for unusually short periods of time. Buffett stated that there are 2 key reasons why he will sell a stock. The first time is when he believes Berkshire requires the funds for a more appealing deal. We would sell if we needed the money for something else. I would reluctantly sell something terribly cheap to buy something even cheaper, said Buffett. After all, Berkshire Hathaway has more than $100 billion in cash, so this doesn't happen very often. It does, however, happen, and we'll go over a recent case in the next section. The second and more usual reason Buffett sells stocks is that fundamentals or the competitive landscape have changed. As Warren Buffett put it, we sell really when we think we're re-evaluating the economic characteristics of the business. We probably had one view of the long-term competitive advantage of the company at the time we bought it, and we may have modified that. That doesn't mean that we think the company is going into some disastrous period or anything like that. We think McDonald's has a fine future, we think Disney has a fine future, and there are others. But we don't think their competitive advantage is as strong as we thought it was when we initially made the decision. Here are a few examples from Berkshire's history to highlight some of these points, as well as some other reasons Buffett and the rest of the company's employees might be tempted to sell equities. Buffett acknowledged that the last of Berkshire's IBM shares were sold in the first quarter of 2018. In a nutshell, Buffett claims that he underestimated IBM's competitive threats, and as a result, the stock has been revalued lower. This is an excellent example of the principle of get out when your initial thesis no longer applies. In recent quarters, Berkshire has sold part of its Wells Fargo stock, which you may guess has something to do with the bank's infamous fake accounts scandal. However, you'd be wrong. Buffett has stated multiple times that he plans to stay with Wells Fargo, although he is prohibited from owning more than 10% of the bank's stock due to regulatory restrictions. The recent sales were exclusively for the purpose of staying under that limit. Many newer Berkshire investors are astonished to learn that Buffett was ever a supporter of mortgage behemoth Freddie Mac. But in the late 1990s, Berkshire owned 9% of the company's stock. Berkshire Hathaway gained a lot of money in the investment, but Buffett began to see some concerning indicators, specifically that the company was taking on too much risk in order to maintain double-digit earnings growth. By the year 2000, Buffett has sold all of Berkshire's Freddie Mac stock, and we all know what occurred during the mortgage crisis. There's a reason why Freddie Mac is now a penny stock. Berkshire Hathaway was one of ExxonMobil's top stakeholders until late 2014. Buffett concluded, however, that oil prices were unlikely to stay as high as he has anticipated. Therefore, Berkshire's whole stock was sold. Warren Buffett prefers to put Berkshire Hathaway's money to work by buying businesses and then buying ordinary stocks in that order. As a result, when Buffett sold 13% of Berkshire Hathaway's Goldman Sachs stock a few years ago, he claimed the need for cash to fund the Precision Castparts transaction. It makes sense to sell if you believe your money would be better spent elsewhere. To be thorough, there are a few reasons why an investor should sell a stock that they should avoid. Don't get us wrong, there's a lot of solid reasons to sell stocks, and even the most buy and hold investors do it now and then. However, it's critical to understand the difference between a good and a bad cause to sell. The stock's value has dropped. This is, without a doubt, the worst excuse to sell a stock. If your original reasons for buying are still valid and the price dropped sufficiently, it should be considered a buying opportunity rather than a selling opportunity. The stock's price skyrocketed. This is something few may have done a few times, and it doesn't seem like a horrible excuse to sell at first. For example, even though all signals pointed to considerably higher vehicle sales and a path to long-term profitability, one may have sold Tesla after its stock nearly tripled from its IPO price. Since then, the stock has risen another 300% or so from when they have sold it, because a billionaire decided to sell. This is true, even if the billionaire in question is Warren Buffett. When a billionaire sells a stock, it's a good idea to explore a little deeper to figure out why. But we are not suggesting that you sell just because a millionaire did. For example, we said that Buffett sold some Goldman Sachs stocks a few years ago, but a little digging reveals that this was primarily to fund an acquisition, rather than due to stock market anxieties. When it comes to investing, the Oracle of Omaha takes a practical approach. Buffett tells forth the details about the firm he's interested in before giving over any money. In 2006, he advised shareholders, "You have to be able to play out your hand under all circumstances. But if you can play out your hand and you got the right facts and you reason by yourself and you let the market serve you and not instruct you, you can't miss." And despite the fact that Buffett is in charge of billions of dollars in assets, practically anyone may duplicate his strategies. Gather your facts first, then figure out how to deconstruct them to get the information you need to make your decision. This involves looking for components that are important and knowable to Buffett. Forget it if it's important but unknowable, he advises. I mean, it may be important whether somebody's going to drop a nuclear weapon tomorrow, but it's unknowable. Concentrate on the variables you already have. After you've narrowed down your information, Buffett continues, you evaluate if you have information of such worth that, when compared to price, will compel you to act. You should base your decision to invest in something on your research, not on what other people are doing or saying. What others are doing means nothing, Buffett says. That's why rather than trying to time the market or react to your fears, Buffett advises completing your homework ahead of time and investing in good companies that will stay. Concentrate on the facts rather than your emotions. During severe market swings in 2016, he warned CNBC, don't watch the market closely. They're not going to have very good results if they're trying to buy and sell stocks and worry when they go down a little bit and think they should maybe sell them when they go up. It's fine to sell stocks if you're doing so for the proper reasons. You should sell if a company's fundamentals have altered or if you can put your money to better use elsewhere. Don't sell only to lock in a fast profit or because everyone else is. With this, we have come to an end. The content of this video is for educational purposes only and hence should not be considered financial advice. All the financial decisions should be made after doing your wide spectrum research. Do let us know in the comment section below. Also, make sure that you like this video, comment down your thoughts, and also don't forget to subscribe to our channel and stay updated about our latest videos. Until then,